So in terms of signposts that we should look at, I think the fixed income markets is where I'm focused on. I am trying to work very closely with our fixed income fund managers and analysts on an ongoing basis. My view is, historically, when you're trying to find problems on a fundamental equity basis, you should always focus on the balance sheet. And therefore, more broadly, when you're trying to think about problems for equity markets in general, you need to find it in the fixed income market. And so the fixed income market worries me at this point of time because of two or three things. One, the Fed is going to continue to raise rates. They've been pretty clear about this, that the new Fed governor wants to add back to his armory in the case of a future recession, because when they were at the zero bound, they really had no tools if there was a recession around the corner. So he's using this environment, this good economic environment, to really stack back his armory by raising rates. And they will continue to do so until we have a problem with US economic growth, which is what he said at Jackson Hole just last week. That has started to have an impact across the world. If you look at emerging markets, for example, they are the weakest in terms of dollar balance sheets, and they've started to feel a little bit of an impact. So, in your point on what's flashing red, I think emerging markets, look at what's happening in Turkey with the Turkish lira. You look at what's happening with the RMB in China. You look at what's happening in Argentina. You're seeing, things flashing red over there. Then I look at the corporate bond market, and I see what's gone in US corporates who have literally levered up over the last 10 years because of this low interest rate environment. Just to give you some statistics, you've got a US corporate which now has more US dollar debt than New Zealand. So AT&T has $250 billion of debt outstanding on its balance sheet. That's more than the debt of New Zealand. If you add the debt in the entire telecom sector in the US, just the telecom sector in the US, it is more than the debt of Russia, India, or Brazil. So these are really big numbers that we're talking about. And this is what has really driven a part of this equity market acceleration, which is buybacks. As rates go up, companies will have negative financial leverage. The zombie companies, which have survived so far without any problems, will find it tougher. The BBB market has grown in size in the US. This is at the cusp of investment grade. If you have any risks on the BBB market, the high yield market is not big enough to absorb all the widening in credit spreads. And whenever credit spreads widen, that is where the bushfire starts for equity markets. So we have to be focused on what's going on in the fixed income markets, because that is where the bushfire will start and will have an impact on equity markets, on equity market volatility, and that's a risk that we need to be thinking about.